Hello, I'm Sophia Bertani, and I will be discussing the Federal Reserve today. To begin with, what is the Federal Reserve? The Federal Reserve is the central bank of the United States. It manages the nation's money supply and financial system. It was first established in 1913 to prevent financial crises and provide stability. The Fed's main purpose is to maintain a healthy economy by balancing inflation, employment, and the flow of money. Moving on to what the Fed does. The Federal Reserve controls inflation by adjusting interest rates, raising them to reduce borrowing and spending when inflation is high. It also sells government bonds to remove money from circulation and can increase bank reserve requirements to limit lending. These tools, along with forward guidance, work together to maintain price stability and keep inflation around a target rate of 2%. The Fed also regulates banks to ensure their stability by setting reserve requirements and supervising their operations. It ensures banks follow laws, avoid risky practices, and protect customers' money. If a bank faces trouble, the Fed can intervene to prevent wider financial issues. The Fed supports employment by lowering interest rates, making borrowing cheaper, and encouraging business growth and consumer spending. This increases demand for goods and services, leading companies to hire more workers. By maintaining economic stability, the Fed helps create steady job opportunities. The Fed processes payments between banks, handles government transactions, and manages accounts for the U.S. government. It also supplies cash to banks to meet customer needs, ensuring the smooth flow of money in the economy. How does the Fed work? The Fed adjusts interest rates to influence borrowing and spending. When inflation is high, it raises rates, making loans more expensive and slowing spending money to lower prices. When the economy is slow, it lowers rates, making borrowing cheaper and encouraging spending to boost growth. This helps keep the economy balanced. When the Fed buys government bonds, it pays money to the sellers, increasing the amount of money circulating in the economy. This extra money makes it easier for people and businesses to borrow and spend, which can stimulate economic growth. Conversely, when the Fed sells bonds, it takes money from buyers, reducing the money supply, which slows borrowing and spending to help control inflation. The Board of Governors is the main governing body of the Federal Reserve. It consists of 7 members who are appointed by the U.S. President and confirmed by the Senate. These members oversee the Fed's operations, set key policies, and make decisions to ensure the stability of the U.S. economy. Each member serves a 14-year term to provide long-term stability and independence for the Fed. The Federal Reserve has 12 major banks located in major cities across the U.S., such as New York, Chicago, and San Francisco. Each regional bank serves a specific district and helps implement the policies set by the Board of Governors. These banks monitor local economic conditions, provide financial services to banks and the government, and contribute to the decision-making on national monetary policy. The Fed matters more than we think it does in both the short and long term. If the Fed raises interest rates, borrowing, like mortgages and car loans, become more expensive, but savings accounts may earn more. If it lowers rates, borrowing becomes cheaper, encouraging spending but reducing savings returns. A stable Federal Reserve helps avoid economic problems like high unemployment or major recessions. It ensures the financial system stays secure for everyone. In conclusion, the Federal Reserve acts as the guardian of the economy by using tools like interest rates, money supply management, and financial regulation to ensure economic stability. It works to prevent extreme inflation or deflation, both of which can harm people's savings, jobs, and businesses. By balancing these factors, the Fed creates a stable environment where businesses can grow, consumers can make purchases confidently, and the overall economy can thrive in the long term. This stability helps foster creation, economic growth, and a healthy financial system.